So let's welcome our panel. Joining us today is Maurice Lewis, a mortgage expert with an inspiring story of resilience and career transformation. Back in 2016, while working in the banking industry, Maurice was at a crossroads. Turned down for a promotion, offered a position that demanded longer commutes with minimal pay increase. That's when he took a bet on himself and made a leap of faith into the mortgage lending world. Starting as a loan officer, Maurice embraced the challenge, learning from industry giants, and eventually found his true passion as a mortgage broker. 8 years later, he's still thriving, helping clients find the best mortgage solutions. We're excited to hear more about his journey today. Welcome, Maurice.
Thank you.
From Nexa Mortgage.
Thank you.
We also have David Ellis, a seasoned mortgage loan officer with a deep background in finance and passion for numbers. The first half of David's career was spent on Wall Street, navigating the fast-paced world of finance in New York City. After leaving New York, he became a partner in a boutique investment bank in Millburn, focusing on the lower middle market. About 15 years ago, him and his team seized the opportunity to purchase a niche publishing company, expanding it into the real estate space, but by helping realtors create marketing materials and build personal brands. These valuable connections with realtors inspired David to transition into mortgage lending in 2017. He joined New Jersey Lenders as a mortgage officer. Please welcome David Ellis with New Jersey Lenders.
Thank you.
And finally, we have Michael Puro, a mortgage professional with strong roots in the lending business. Growing up in Springfield, New Jersey, Michael attended Villanova University before joining the family tradition in mortgage lending. With a father and older brother both working in the industry, he decided to give it a try after college, taking a job alongside his brother. The rest, as you can say, is history. We're excited to have you here today, Michael, from Embrace Home Loans.
Thank you, Kim. It's a pleasure to be here.
Thank you. Okay. All right. So, Maurice, I'd love to start with you.
Okay.
What specific areas of mortgage lending do you specialize in, and how does that benefit your clients?
Well, we offer a lot of products, but what I specialize in for myself is really the low credit score borrowers. We're FHA. I do fix and flip and ground up construction loans as well. So those three areas I'll focus in on.
Okay. In your experience, what makes a lender stand out in a competitive real estate market?
Service.
Yes.
We're all in sales, all three of us, but it's all about service at the end of the day.
Yes.
So if you're able to provide exceptional service, you stand apart from a lot of people just making phone calls to get business, or someone saying they can do something and don't show up to do it. So if you are able to compete on a level with your interest rates being the same, the only thing that you'll stand apart is your service and communication with all parties.
Absolutely. And that is why all three of you are my partners. You give exceptional service to each and every single one of my clients. For that reason, it will be a lifetime relationship between us two.
Appreciate it.
Okay? All right. So just to jump ahead a bit, I know that you mentioned that you were a mortgage broker. And if you didn't, hopefully they'll just scratch that out. So I understand you are a mortgage broker.
Yes.
In what ways do mortgage brokers and loan officers differ in their approach to helping buyers secure a mortgage? And how can understanding these differences benefit buyers in a competitive market?
From my standpoint, because I was a loan officer before becoming a broker, it was just options. And when it came down to some of the companies I work with their overlays that could have qualified a buyer based on the guidelines, but because of some overlays, we were held back. And for me, it's like, well, if this person qualifies, they should be able to purchase a home. So being a broker, I have those options. So right now I have over 200 plus lenders that my company is signed up with on a conventional FHA, VA scale, even USDA. And then we have about 80 partners for hard money bankers.
Absolutely.
Lenders, excuse me.
I mean, there's so many times I have some people who are so passionate about becoming homeowners, and they are so discouraged because, they've met with a few lenders over, a short period of time and have received denials. And when I receive those clients as referrals, I immediately think of you because it just seems like you're able to get people approved in so many different ways. And I know that you mentioned overlays. You know, one of the things, one of the terms that I've learned in this business. So can you just explain a little bit about overlays, what they are, give us a few examples?
Sure. One of the key ones that I found is a credit score overlay. FHA says we can go down to a 580 credit score, 3.5% down. If I'm with a lender that says, you know what, I need a 620 to help you out, well, that leaves 40 points difference, and there's plenty of people that come to the market looking to buy a house between a 580 and a 619.
Yeah.
They should be able to buy, and they have the funds to do so. So as long as we can get them, even if it's a manual underwrite or a AUS approval, then we're okay to move forward. So that's one key factor. Some lenders have reserve overlays if you have a certain credit score as well.
Yes.
An overlay with that will cost the borrower money at the end. Not necessarily cost, they just need to have that money set aside
Right.
for that additional month or 2 months rent, whatever the overlay may be. So that can increase the closing costs because they need to show that money is available and from them.
Absolutely.
Those
Right.
are two examples. Yeah.
So that's a really great example, you know, so it oftentimes, you know, working with you can sometimes save, you know, a bit on closing costs, right? Even though, you know, the credit score requirement may be a little lower, the interest rate might be a little bit higher, you know, it is a difference between being able to get an approval and not getting approval and moving forward and eventually becoming a homeowner.
Correct.
Because that first year of paying those mortgage payments on time, it will transition them into a positive
Correct.
credit score.
Absolutely.
All right. So how can working with a mortgage broker potentially give buyers an advantage over using a loan officer when trying to secure the most favorable mortgage terms in the seller's market?
I think we have to look at the situation. I mean, only because brokers, we have the same products, right? When we talked about overlays, when it comes down to being a broker compared to a lender in the seller's market, you want to look at speed. There are plenty of lenders that can say, all right, listen, we can get this done. Well, I can submit a file today, get an approval from my underwriter today. Most lenders can't compete with that. They have, 24 hours, 48 hours turn times. And we're only talking about a day, but sometimes that day can make a difference.
I mean, time is
right?
of the essence in real estate. Absolutely.
Right.
Yeah. And really also, you know, bringing less money to the table in terms of closing costs if people are prepared to save, you know, can help them be a little bit more competitive in their offer, right?
Correct.
As it relates to appraisal waivers or even limitations, right? Especially now, you know, since commissions can be negotiated, you know, that money could be deferred to make their offer a little bit more competitive. So, you know, that makes complete sense. So what loan types are or are not available through a mortgage broker?
So the one that I would say that's not available is if you're looking for down payment assistance program, you're looking for like the state of New Jersey's NJ HMFA. We don't have that available
Right.
to us. They don't allow that available to brokers.
Absolutely.
Do we have other down payment assistance program? Yes, but if you're looking specifically for that, I can't help you, and I'll let you know up front. If you're looking for that program, I'm gonna have to refer you out because I can't touch that program. But outside of that, everything else is basically available to us.
Yes. And I know that there are a lot of people who kind of fall outside of the 590, I think was the minimum score. If I'm if that was correct, what did you say?
620 for the NGH MFA.
Correct. Yeah.
620.
Right. But as a mortgage broker, you had mentioned that sometimes you could potentially find.
I can find a
buyers
down
loans.
payment assistance if you have like a 600 score.
Right.
We have a lender that will go down to a 600 and give you the down payment assistance, and that's for a manual underwrite or a AUS approval.
And how low can you go for like a FHA approval in general?
Well, we can go down to a 500 if you're bringing a 10% down. But if you're 580, only had 3.5%, you need to get to a 580.
Right. Now, I have some clients of mine who, you know, want to be homeowners that just have sometimes young credit, right? Or then some people who just have some credit challenges by, you know, not necessarily managing it the right way because, you know, they didn't have credit counseling or, you know, weren't aware of it. But, you know, somehow you have worked with some of these buyers that I've referred to you, and in a short period of time, in 2 weeks, sometimes, you know, 30 days, you're able to approve them through a rapid rescore program.
Sure.
So I really like to talk a little bit about that. How can credit counseling services guide buyers in understanding their credit profiles and improving their chances for qualifying for a traditional mortgage?
Most people don't realize what your credit is made up of. So it comes down to a part of education for them for life with it. So if I'm able to see their credit card balances are extremely high, or they have an old collection account that's $200, something nominal. All right, let's call and see if we can get things worked out to get that removed. Are you able to talk, or do you have the funds to pay for a credit counseling agency with we partner with in order to get some things removed? Are you able to pay down this debt? All right, so if you're able to do these three things, I can get your score from a 534 to a 602. Then we're good within, as soon as it completes. Once you complete and I get proof, it's going to take 5 days for that to populate.
That's
Do
wonderful.
the rapid rescore.
Yes.
So depending on the situation, you will have to put out some funds, but your credit score will be higher. You're able to buy a house, and we can set you on your journey.
I mean, and listen, it's very helpful, even for some of the FHA buyers that you find themselves competing for homes in markets where conventional mortgages are more likely accepted. Sometimes a small little, rapid investment into the rapid rescore
Correct.
program, can get them to a higher credit score where they can potentially qualify for a conventional mortgage and be more competitive. All right. So what specific strategies can credit challenge buyers employ to enhance credit scores quickly before applying for traditional mortgages like FHA?
Reducing debt, making sure your balances on your credit cards are low. But outside of that, there's no other factor that will help them with FHA, but it's just making sure that your debt to income ratio is in line, which I'll coach them on and make sure that it's in line for FHA.
All right. So what are key factors to consider when comparison shopping for mortgages in a highly competitive seller's market? And how can these factors influence affordability for homeowners?
Some of the factors will be your speed, service, what customers look for, speed, service, and rate, basically. If we're able to, one, conveniently just tell them, listen, we can get this done within a 20-day period. Your rate, if you're looking for a low rate, sometimes I have to tell buyers, since I have 200 lenders to go against, I may not give you the best rate, but I can give you the speed if you need it. And sometimes it has to be a conversation. Sometimes the best rate may come with a longer closing, a full 30-day closing. But it's all about what that customer needs and how it will impact the transaction with the sellers as well.
Absolutely.
So again, it's communicating with the realtor partner and seeing if this could work.
Every deal is definitely different. All right. So I want to turn my attention to David. So David, Maurice did mention, a limitation, right, of qualifying for what I would consider the traditional kind of CRA type lending programs, which I know that you are amazing at, right?
Awesome.
So what is CRA and the fiscal responsibility of local lenders as it relates to CRA?
Okay, well, CRA refers to the Community Reinvestment Act. Big picture, financial institutions as a whole are required to provide benefits to, call it certain demographics, be it low or moderate income end of the chain. This is not just in real estate. We're talking about real estate because that's what we all do. It could be an SBIC loan at Chase Bank, or it could be some other lending product that the institution has. In regard to mortgages, the banks are required to provide this assistance. They have to compete for the business. So the way they do that is with better financial terms. It's basically a couple different areas where they use to induce the borrower to come to them. It could be a better interest rate, certainly below market rate to some degree. It could be lender credits, down payment assistance, which is what Maurice was talking about. The biggest benefit, likely in most cases, is the ability to waive PMI. PMI is that additional monthly charge, typically monthly, that borrowers have to incur when they put less than 20% down towards a purchase. It could be some combination of all those three. In regard to NJ lenders, kind of like Maurice, we broker CRA products from 3 or so different financial institutions. Lakeland, now Provident, is one. Chase is another. Citi is a third. So we're in this game. We're active in this game, and it's something we go after hard.
I mean, listen, it's a fantastic product when you consider some people who stepped away from the market and have come back now, qualify for conventional. They save money and have 20% down, and now to realize that they have this product where they can put 5% down and avoid PMI completely, which gives them that extra 15% where they can be a little bit more competitive. And then the combination of having a below market rate when, you know, a lot of buyers are so sensitive to the high, what they define as a high rate environment. You know, when you look over, you know, over the years and in finance, I mean, really, I mean, we're still at record lows, right?
No,
But the
that's
reality is-
absolutely true. I mean, we're warped currently. I was in my youth, I was in the double digits.
I
So
mean, listen, I don't even want to talk about when I bought my house, how much my rate was. You know, it's so disrespectful. So at the end of the day, you know, some people who are sensitive to that rate conversation, you know, if they do invest in a CRA product find themselves that even if rates, you know, lower, they really don't have a need to necessarily refinance. So
well, the rate's good. Again, the biggest likely benefit when you get down and run the numbers is the PMI savings, and that's helpful to this, you know, to monthly budgets.
yes, okay. I think you covered, you know, a lot of these, you know, questions. In what scenarios might a buyer choose a CRA lender over a FHA conventional or VA loan, and what are the potential trade-offs associated with this choice?
Well, again, it just comes down from my end is presenting the options, our end, educating the buyers, the borrowers, you know, what the different paths are. Frankly, the CRA is mostly always the winner.
Yeah.
Just given the obvious. Keep in mind, you didn't mention this. It's not just purchase; it could be a refi also.
Oh, really?
Yes, you could
Oh, I
refi and
didn't know
get
that.
the benefit. Yeah, absolutely.
Does it depend on area? Like, are you still
Well, again, the area is
concentrating in a low
correct.
income
It's
moderate?
still driven by the demographics, which is designated either moderate tract or low income tract.
Okay.
And then we have websites we all go to plug in the address and see where we are.
Right. Oh, that's wonderful. You know, so oftentimes I find myself with buyers who believe that they have to go FHA because this is the first time they're buying a home. But I understand that there is a difference between a first-time home buyer and a first, for instance, generation loan product. So what are the specific differences between a first-time home buyer loan and a first-time generation loan? And how can these differences impact eligibility and affordability for new homeowners?
Okay, you're mixing a couple animals or a couple different
Am I?
couple things.
Did I should probably-
Basically, let me take a whack at it. What you're referring to is what Maurice started with is the NJH MFA program through the state. And by the way, this is just not unique just in New Jersey. You know, it's in Pennsylvania, for example, and other states. Most states offer some kind of state assistance towards first-time ownership, if you will.
Right.
And so in Jersey, it's this NJH MFA program. Within that program, there's an additional benefit that can be had, which is called first generation. So that's why I say you're mixing stuff together. The NJH MFA program is basically county specific. It's either a $10,000 down payment assistance or $15,000 down payment assistance as a lump sum of money provided at closing towards the equity of the transaction and the closing cost of the transaction.
And that's for first-time home buyers?
Correct.
Okay.
Correct. To be in this program, you're a first-time home buyer.
Okay.
And again, to get the incremental additional benefit, I'll circle back to this, of first generation, that adds $7,000 also to either the $10,000 or $15,000.
Okay, so.
Am I throwing too many numbers at you?
I mean, for real. So let's maybe, just so that I understand it, for the first-time home buyer, can we talk a little bit about that program first?
This is all first-time home buyers. Again,
Okay.
This is
Correct. So,
The first generation is in addition to the first-time home buyer program, so it's like an
Yes.
add-on.
absolutely.
correct.
So, I thought that it was still called first-time home buyer.
It is-
But is it called something else?
it's an addition as
Right.
much.
So first-time home buyer, there is a separate, kind of program for first-time home buyers if they don't fall into the first-time generation loan
No.
category. No?
To get the first
Oh, Jesus.
generation,
Everything is going to be first-time home buyers. If
Okay.
your parents, grandparents never owned a home, you're first generation. That's added on to it. The additional $7,000, but you're still a first-time home buyer.
Okay.
So you start
what
off-
should I call the product?
just call it
That's
NJH MFA.
NJ
We
HMFA?
call it first-time home buyer. First-time home buyers.
I thought that was simplifying it.
The
Okay.
NJHMFA is the housing agency through the state of New Jersey that
Right.
offers the program, the guidelines, and everything that comes with it.
Yes.
More commonly known as the NJ Bond Program. It's easier than the acronym NJHMFA. But then within the bond program, or the state program, however you want to refer to it, you have multiple programs. You have the first-time home buyer program that offers a lower interest rate and has the additional credit of $10,000 or $15,000, depending on which county you're purchasing in. There's also another program above the first-time home buyer that has higher income limits. So it encompasses more clientele, but it also has a higher interest rate in that regard. Those are both FHA products that couple with the state grant that comes with it. A couple years ago, the state brought back a conventional product as well, offered through the state. So it's basically the same thing as any other conventional mortgage, but pairs with the down payment assistance and also comes with the state's interest rate. So the state dictates the interest rates on all these programs. In a lot of cases, the clients could get a lower interest rate if they didn't go through the state, but then they would forego having that grant of money. So then they have to weigh out the differences. Do I take the money but a higher rate, or do I just forego the money and take a lower interest rate? And then that's up to the client. And everyone here knows our job is to just show the numbers, show the options,
Right.
explain them in detail, and allow the clients to make the decision that they feel is best for them, their families moving into this new home.
Absolutely.
So again, just to continue that, thank you. All that, the down payment assistance of 10 or 15 grand gets increased by $7,000 if you can check the box of being first generation.
Yes. And tell me a little bit about how you would qualify for a first generation.
Well, again, you by definition yourself haven't owned. And that's but if your parents don't own anywhere, like anywhere, then you can qualify.
Good. So it doesn't extend to aunts and uncles?
Yeah, aunts and uncles are off the table. We don't have to worry about them.
Okay, good. Because sometimes that arm length comes into play, and I'm just like, it doesn't. Like, if I know somebody that owns a home, is that bad? Okay. Okay.
Just to close the loop here, if we're going, it's sexy, 10,000, 17,000, 15,000. It's all sexy. This is what we all stress, have to be aware of. If you unwind that mortgage for whatever reason in under 5 years, unwinding the mortgage could be hitting the lottery and paying off the mortgage.
Oh, wow.
It could be getting a new job out of state and having to move and having to sell the house and repay the mortgage. It could be rates driving down to 2% and wanting to refinance the mortgage. Whatever the reason might be, if you're unwinding that mortgage in under 5 years, you got to repay that grant in total.
In total.
In total.
So it doesn't
So it's called,
decrease?
it's not pro rata, it's cliff vesting, you got to repay the whole thing. So people have to just factor that into their calculus when they decide whether they want to go for this or not. But the rates generally, I agree, are full, not horrible. They're good, not spectacular. They're good. The real sex appeal in this program is the down payment assistance. At the end of the day, I'm sure you've seen it.
Yeah.
When you add the mortgage together with this assistance, it's often more than 100% loan to value, other people's money to purchase price. And it's helpful to first-time buyers that just don't have the cash to get into the game.
Well, listen, if the seller market persists and values continue to grow as they have this year, then, if a life change happens within the next 5 years, you can easily pay it off with that equity that you accumulated in that very short period of time. All right. So, definitely they would have to consider it holistically. So to correct and make sure that, this is understood by the audience, these are 2 FHA products.
It's 2 FHA, and there's a third one that's
potential
conventional. So basically, when you're looking through the profile of the borrower, with the income limitations, with the debt-to-income calculations, you kind of figure out which is the best fit. The third item is some developments, condos, whatever, they might not even take an FHA loan, so you're immediately pushed to the third one, which is still the upfront assistance.
Yes.
Which is great.
I mean, it's just wonderful, that you don't always have to, commit to FHA just to take advantage of a first-time home buyer benefit, right? Especially, in moments where, you would like to buy something outside of a traditional home or be more competitive in the market.
Agreed. For years, the state didn't offer the assistance behind a conventional product. They had at one point, and they took it away, and I was very happy they brought it back. Because you want to be able to offer both of those products to anyone who qualifies for the grant and assistance.
Yes. All right. I understand that there are special purchase loan options for sellers, which I think is a tremendous product. Okay. Can you tell us a little bit about that product and how might a lender's special purchase program allow a seller to buy a new home, potentially in cash, while selling their current home without contingencies?
Sure. So this is, we launched some nice new products last year. Frankly, this is my favorite, Mike.
Yeah.
We call it Home Sale Assured. Basically, as you're in this market and you're bidding on a house, if the seller looks at all the bids that come in, and if there's anybody that in that dozen or so that they receive that says, I have a home sale contingency on my offer, your offer is going to get thrown out. You're dead. You're wasting your time.
Yeah.
So you have to find a way to get around that. So we launched this product called Home Sale Assured, which enables me as a lender to pre-screen and qualify and fund the borrower as if their existing house didn't exist. They're cleansed in terms of what their capabilities are. So I give them pre-approval and funding as if, with no home sale contingency. So the seller sees that there are no strings attached from the lender to potentially jeopardize the deal and have it go sideways. The other issue that you got to think about is basically, you're making the offer, and you got to your existing overhead, if you will, limits your debt capacity for a purchase. So if I have, for example, a $500,000 home with a $300,000 mortgage, I'm upsizing to an $800,000 home, and I need a $500,000 or $600,000 mortgage, something more. The drag on my existing mortgage, plus the homeowner's insurance, plus the taxes, all that housing expense on my existing house limits my capacity to qualify for a new mortgage for the bigger house. So again, we use this program to, again, cleanse the borrower so that we can pre-approve and fund them for the purchase. The way it could play out is they get a mortgage for the bigger house, they close on it, they now own two homes. They don't want to carry two homes. They're only going to live in the new home, but they're long, if you will, these two homes. They've got 120 days post-purchase to sell the old home and do what they want with the proceeds in the future. So this way they can juggle their assets to get to the new place, which is what they want to do. Given where I am in my life, I see a nice application here to downsize. Say I'm moving into an adult community. I've got a $1 million home in Biscayne Ridge, and I want to buy in this community in Bridgewater. The entry price is $500,000. I can use this program, get them qualified for a $450,000 mortgage for the purchase. They buy the new home. They have two homes. They intend to sell their old home, obviously, within a period of time. When they sell the old home, subject to early payoff, they could use the proceeds from that future sale and get rid of the mortgage. So in that scenario, they don't have to dig as deep into their IRA, their 401k, their brokerage account, their other assets to get to the table. So
the wonderful piece about it from a realtor perspective is that it benefits both sides, right? Because normally if a seller, wants to sell their house so that they could purchase another home, and it's required that they use those proceeds from the sale in order to be able to afford the home, then they would have to, normally disclose, not on both sides, that, I'm selling my house with the understanding that, I need to find a new home, right? And if you are the seller and you're purchasing, you need to sell, then you also have to disclose to that potential seller that I, understand that this purchase is contingent upon, me selling my house. So it definitely puts you out of the running, but it also would, add so much time doing it the traditional way. This saves everyone time, and, time is money and time is of the essence in real estate. So, it's a wonderful product all the way around for realtors as well. So you had mentioned that there was a 120-day
Forward.
forward. So after the seller, purchases their new home, that's the day that the clock begins for them
Correct.
to sell.
It's actually it's after the buyer purchased their new home.
Yes, after the buyer.
Okay, so keep in
purchases
mind
their
that
home,
it's
even though they're selling at the same time.
You're talking about the seller.
Exactly. Exactly.
you got to keep your hat on right.
But
But
they're still selling their home.
okay,
so
so look at it this way.
Client.
I'm looking.
The client.
The borrower buyer gets a house under contract. Sometimes they close in 30 days, sometimes they close in 45 days, sometimes they close in 60 days or longer. That lead time is in addition to the 120. So during that lead time, a superstar realtor like Kimberly Taylor, she might be able to get that existing home sold simultaneously.
Yes.
But if she doesn't, that's incremental time.
Yeah.
And then that's when the clock starts ticking, once that closing happens going forward.
So what happens after 120 days?
After 120 days, and by the way, this has never happened.
Right.
Okay, so
It's more than enough time. in
so
this market.
I'm explaining this. This has never happened. If after 120 days, it's not sold to some other party, it gets sold to our partner, Home Sale Assured, at a favorable price. Say it's 20% below what you would list it for, some discount. Our partner agrees to two things. He agrees that he will continue to use the same realtor team. He's not out this to steer it to some other party.
Oh, that's very nice.
The bigger thing well, they're both big. The other thing that he agrees to, he's not in this to own houses. He's in this to just churn, to flip. He will sell that house, and he will give 90% of profits that he receives on that subsequent flip back to the original homeowner.
Oh, how lovely.
So, again, I just got it's never happened. But if that were to happen, this is how they would, shock absorbers is what I call it, to help people get comfortable with the concept.
Okay. All right, wonderful. So, speaking of competition, Michael Puro.
Why am I the
that right?
competition?
No.
We're friendly.
I have lost so many deals, because of you and your appraisal waiver product that
Competing
you offer.
against my buyers?
Competing against your
I'm sorry.
buyers. Yes.
That's why it's better to join us
I
than to fight
know.
us.
I mean, clearly, if you can't win, you have to join. So that's exactly what I have done. All right. I've learned
Wonderful.
my lesson, the hard way. I had so many buyers that were, just had a lot of assets, right? They were able to qualify for conventional. They were able to put 20% down and more. And oftentimes we would make offers that were $100,000 over asking. We would, not completely waive appraisals because, obviously they wanted to, avoid PMI. But they would, say, hey, we will limit appraisals. If the house doesn't appraise, we'll give you an extra 45 or 50. And my clients were losing bids. And they were like, Kim, what are we doing wrong? And I'm like, listen, on paper, this looks amazing. I mean, outside of being able to completely waive the appraisal, we're limiting everything else. And the house is wonderful. So we're taking it completely as is and waiving, everything except, something structural or major. I couldn't understand what we were losing until I learned about this product. Sure. So please, can you tell us how can you tell us how a mortgage appraisal waiver supported by a tool that estimates property value stability over the next 3 years influences a seller's decision in a fast-moving market?
Okay. I think you touched on a lot of different things there, and so it's something that's definitely something to talk about. First, I'd like to thank you, because I know you talked about Maurice here is being excellent with low credit score clients and David being excellent with CRA programs, but that you're reserving your A-paper quality best clients for me. Thank you,
That's the
Kim.
only way
I
I'm
really
gonna win.
appreciate that.
You're very welcome.
But I do like all the clients too.
Yes.
But no, what we really do and what sets us apart, what our focus has been, is always being acknowledging or addressing the difficulties in any marketplace and being able to respond to them. And what we've seen over the last 7, 8, 9 years is an increasingly tougher sellers market, where it's been incredibly difficult for buyers to get offers accepted. And the greatest thing that we can do as a mortgage lender, as a lending team, is help you get more contracts.
Yes.
I mean, any lender can pre-approve your client. I tell people all the time, it's like, listen, I might not be the lowest interest rate out there. Nobody ever is. That's not saying my rates are high. It's just saying you can go online and find something cheaper. There's always a wholesale discount lender out there. You compete with it in the real estate world. You expect on the list side 3% is a fair commission, but someone's out there selling it for 1% or $1,000 transaction fee. We all compete against those people. We know their service is never what our service is.
Absolutely.
But I tell people all the time that I might be at 6% today on a 30-year fix. You can find 5.75, but I'd rather close on a house at 6% than keep shopping for one at 5.75.
Absolutely.
The difference is, are you actually going to buy a house? And what we want to do, and what we want to, our benefit to you as an agent, is that you're not going to keep showing your clients homes. You're actually going to get a contract. What you do after that is entirely up to you. When I was a younger man, I used to say, you can move on and get another client, spend more time with the next client. As I've gotten older, I understand that there's a lot more to appreciate in life. So I want to maybe spend the afternoon with the kids, do some things around the house. And I don't care what you do with that extra time, as long as I'm the one helping you have it back. So whether it's be time with the family, time to yourself, or the next client, whatever it is, I want you to be able to get your contract so you can move on with the rest of your time ahead of you. How we do that is help clients have better terms. We understand that in this market, it's not just the highest price that wins.
Yes.
Again, I also tell people, sure, you can go to that other lender, you can maybe work with them, but if they're not helping you have greater terms, all you have to do is win is price. You may have to spend $25,000, $50,000 more to get the same house that you could have won with me with better terms. So why are terms so important? Well, terms are guarantees that we make to the other side. Buying a home is a negotiation, and we're both trying to put into it protections so that we can get out of the contract if we have to. If something doesn't feel right, something's not going the way we planned it, or we just don't like something about this home, we want to be able to back out of that contract. There's a mortgage contingency, there's a home sale contingency. All these things protect us as buyers or clients, and just as the same as sellers want to have certain things that protect their interest.
Right.
So when you're a client, you're a buyer competing against other people, then you are going to forego some of those protections. You're going to give up some of those contingencies that protect you, yourself. And you're taking that risk so that you give the seller greater assurance that if you take my offer over Maurice's offer over David's offer, that I'm the one who is a sure bet. You're going to close with me at this price, at these terms. So what are those contingencies that people have started to forego? Some people give up home sale contingencies. That's not up to us as a lender. We don't play in that in that field. But what we do help people is have greater terms when it comes to addressing the appraised value of the home and even the mortgage itself. So why would somebody want to say, hey, I'm going to buy your house for $1 million and let it appraise less than that? It sounds crazy. Why should you pay more than what the appraiser puts on the report? Well, there's a lot of things. Appraisal reports are based on older information.
Yes.
These are homes that have sold 1, 2, 3 months ago that were negotiated 4, 5, 6 months ago.
Right.
Now, in some of these past years, when the markets increase over 10% in the year, now if you're looking at sales data that's 6 months old, that's half of that increase. That's a 5% difference. So that means that appraiser is working off of that data that is a little bit old. It's not the prices that people are negotiating today. So we need to help our buyer say to the seller, It doesn't matter what the appraisal is going to be. I'm going to still buy your house for $1 million instead of the appraiser coming in 5% less at $950,000. And that is a scary concept to a lot of people, but it's been forced on a lot of people over these years. And some buyers not understanding what they're getting themselves into. Yeah. I've had people call me and say, I don't know, I was told I had to do this. Now to underappraised by $150,000. I don't have the money and my attorney says I'm screwed.
Yeah.
Like, that is not a situation anyone wants to be in. So what we do is we step in and we analyze, look at every offer that's being made for a client who's pre-approved with us on a conventional mortgage. Conventional mortgages now we're doing up to $1.203 million. So it is a large group of people that fall into this category. And if your offer, we feel comfortable enough in the price that you're offering, we'll say, go ahead, you could waive the appraisal completely. We issue you our property value certificate, which is our guarantee that says, if you offer $1 million, and we'll do this as little as 5% down. We issue more of them at 10% down. We issue more of them at 20% down. But it is as little, some people thinks it has to be 20% down for a conventional mortgage. That's not the case. Our appraisal waivers will do as little as 5% down. And we say to the client, go ahead, make your offer, waive the appraisal contingency altogether. There is no such thing as an appraisal contingency in the contract, but that's an aside. Right. We could talk about that. We all know what this means when we're talking about it. And if the home underappraises, we'll cover the difference for you. So we're telling the client, and that's like the mic drop part. We're covering it for you. All risk is back on us as a lender. So if you make an offer and you're on $1 million house, you're putting 10% down in this case, and a $900,000 loan, if it underappraises, nothing changes for the buyer. They don't have to come out of pocket with any extra money. So a lot of people understand it that they have to pay the difference. If it appraises at $950,000, that's an extra $50,000 they have to come out of pocket with. Some people don't have it or they're not comfortable doing it.
Right.
So what we tell them, they're still going to borrow the $900,000, make the same down payment, no extra money out of pocket, no change in interest rate, no change in fees, no adding PMI insurance to the loan because your equity position is now less than it otherwise would have been. There is absolutely no change in terms to the client. This gives the client the ability to have their cake and eat it too. They get to make the stronger offer without assuming the risk of doing so. Yeah. That's how we help more clients to win more offers, by giving a greater assurance to the seller to say, hey, we might be at $1 million, they might be at $1,025,000, but what's the guarantee that you're actually going to close for $1,025,000? Take our offer instead.
I mean, and listen, I've lost a lot of deals just because of that, and I was clearly the highest offer, right? But I did not have the best terms.
And and tell everyone that if you don't work with this team and have their terms, you'll be forced to pay more and you still might not get it.
Absolutely. And I mean, listen, when you think about it, to the point that you made earlier, you can often save. Now you don't necessarily have to be $100,000 over the asking price, right? You can still, of course, be well over the asking price comfortably. And you could use that money in different ways and still have the better offer on the table. Yeah. Right?
And of course you can. And we never know what other offers you're going to be up against. And even right now, while things are slowing down, and someone said the market's slowing down, and I said, let's keep in mind that doesn't mean values are coming down. It just might mean that there's less activity. There's less activity because less people buy this time of year and there's less homes on the market. But it doesn't mean prices have come down. Right. So we still have to come in with a very strong offer, as good an offer as we possibly can. I tell people this isn't a silver bullet. It doesn't mean you're going to get your offer accepted, but it can be the reason you're chosen over somebody else. Right. And that's the most important thing. So, we still have to have as good an offer as possible, because if you're not, you might not be up against 30 to 50 offers like 2 to 3 years ago, but it only takes one to beat you. Yes. So let's not be number 2 out of 2. Let's make sure we're still giving our best offer, but our terms are going to help you be the one that's chosen. Absolutely. And I think, a lot of my clients have had a lot of peace of mind knowing that if there is an appraisal gap because the house underappraised, that they don't have to come up with those extra funds. Absolutely. Right. Yeah. So you had mentioned before, with this type of product that there is not an additional PMI. So
Would they have to put down 20% to
No.
avoid PMI, or if
So-
they put 5%, there's still no PMI?
So nothing in addition. So if they're putting 10% down and their mortgage, the terms that they're agreeing to is 10% down, it has PMI. If the property under appraises, it in other circumstances it could cause them to pay a higher PMI. We're guaranteeing to them that they will not pay any higher PMI payment in that case.
Okay.
So they don't have to put 20% down. It's just whatever the terms were that they were looking at originally will remain intact. Nothing will change to them.
Right. And since this
Kim,
is a conventional,
this might help. Let me try, just to supplement. There are different ways to pay PMI. It doesn't have to always come from the borrower. So what could be happening is the lender could make good on the delta, the shortage, on behalf of the borrower, so the terms don't change for the borrower. And that's,
Well, correct. Without getting the behind the scenes to it, if you want to pull the curtain back, yes, we're paying the difference when it comes to the PMI, or if the home underappraised enough and we have to pay towards their down payment, we'll pay towards their down payment. So it's whatever it takes to keep the client's terms the same.
right.
So we've paid money towards people's down payments, so they have a larger down payment. We've paid their PMI. We paid gaps in their PMI. Really, whatever it takes.
Well, the wonderful thing, if I'm not mistaken about PMI as it relates to a conventional loan, and I know this is a conventional loan product, is that PMI is kind of tiered based on your credit score, right?
Yes, it
And
is.
how much you put down, all of those are factors.
Correct.
So
Correct.
if you even if you aren't necessarily putting 20% down, but you have, maybe on the higher end, on the credit score spectrum, your PMI could still be reasonable. And
Very much so.
let me ask you, some people, and I don't know if this is an option, so I just want to ask, but I've spoken to some lenders that will allow the borrower to pay off PMI at closing, so they don't even need to pay it as an additional monthly expense.
Correct.
Is that
So
possible?
PMI could be paid in a single lump sum. It could be added into your loan amount. It could be paid by having a higher interest rate, and it could be paid as a monthly line item, like just an added expense on the monthly payment. Now, all those methods of alternative methods of paying PMI are great. I show them to clients, but I don't think right now it's not really the environment to be choosing one of those other methods. And
Right.
the reason I say that is because going with the monthly PMI payment option is probably going to win out in the end, where we're in a market where no one expects to hold their mortgage for a very long time. That means everyone expects interest rates to come down enough within a period of time. It could be, some people still think maybe in the next 12 months. I don't think so. 2 to 3 years, definitely, where they're going to be refinancing. So if they're going to be refinancing out of the loan, or if they're expecting to do so, then you don't want to pay that lump sum up front. Because once you pay it, it's done, it's paid. So why do you make a lump sum payment up front? It's so that you pay less over time. But if you don't hold that mortgage long enough over time, then you didn't recoup the cost of paying that lump sum up front.
All right,
So,
that makes sense.
yeah, I think right now the monthly PMI option is probably the best.
Okay.
just to take that one step further, Mike, when you refinance in 2-3 years, chances are your house is going to appreciate. So between paying down the mortgage and the appreciation, you're going to have the loan to value dip below 80%, one way or another.
Right, exactly. So the next loan won't be subject to PMI, or even if the next loan is subject to PMI, it's still you didn't hold the first loan long enough to recoup the cost you paid up front
Right.
in monthly savings.
And generally, what is that time frame? Does it vary?
Oh, it
depending
always
on-
varies.
It always varies.
Always
Okay.
varies, yeah.
All right. All right. All right. So I find that this helps my buyers that are shopping in suburban markets the most, this product. I find that, this is where, competition is incredibly high. And, you have to, always consider, am I competing with someone who can afford more?
Oh, yeah, absolutely. I mean, I think our product works in all areas, anywhere that you're competing against other people.
Absolutely.
Anywhere where there's more buyers than there's sellers.
Right.
Like take this product to Florida, take it to Texas, New Orleans, San Francisco. Doesn't help. There's an abundance of inventory there now. in those markets, we'll have to adapt and think of something else and a new way to be creative and a new way to lead the market. But right now, where we are, this is one of the leading factors to help people buy a house.
I mean, absolutely. If you qualify for a conventional loan in any market, this is the superior product. Absolutely.
Now, we do take it one step further.
Please, I'm open to the discussion.
So a lot of lenders will underwrite a client up front. So it's not just a pre-approval, what a lot of people like to refer to as a pre-commitment, because you've actually not just spoken to the mortgage loan officer, but you've gone through the entire underwriting process. That is not new news. Lots of lenders have been doing that for quite some time. It is a greater assurance because you've been fully vetted. But what we've done is we've said, okay, if you get fully vetted with us or fully underwritten, and your offer qualifies for our appraisal waiver, we're going to allow you to waive the appraisal and waive the mortgage contingency. So that turns the client's offer into a cash offer. If they are, it says, my purchase of this home is not contingent on me getting a mortgage any longer. In a what would happen if you were a listing agent, Kim, and someone says, I'm waiving my mortgage contingency? What would you ask them for?
They're waiving their mortgage
Yeah.
contingency? I mean, generally, we would want to see proof of funds.
Perfect.
Right?
That's exactly what I wanted you to say.
Yeah.
So if someone's making a cash offer, you have them show you the cash to do it.
To do it.
But in this case, our client doesn't have the cash to buy that $1 million house. They are putting 20% down or 10% down, whatever. But they're now waiving the mortgage contingency, which means they don't have the protection any longer that if their loan is denied, that they can get out of the contract.
Absolutely.
What we do as a lender is we step in at that point and we say, listen, Kim Taylor is our client. We're Embrace Home Loans. Her offer is not contingent on appraisal, and it's not contingent on mortgage. If for any reason Kimberly Taylor cannot get her mortgage approved with us, we'll step in and buy the home for cash. So we are making a cash backup offer to the seller so that if they accept your offer, your client's offer, that they're going to get that price. The mortgage being denied cannot kill the deal. We step in and we buy it for the same price that's on the contract. We do not review the home inspection. We do not change any other terms of the contract. We simply step in and buy the home instead of that, because now that client, they lost their job. They screwed up their credit. They went out and bought a boat. Whatever they did that they can't get their mortgage approved right now, we step in and buy the home. So that is the greatest assurance we as a lender can give to take this offer to the sellers, to say, you take this offer, you're getting your money.
I mean, that's fabulous. That's fabulous. See why I've been losing so much. Okay. All right. So
Not any longer.
Not any longer. Absolutely. Those days are over. Okay. All right. So is there any particular home that would not, for instance, qualify for this type of loan?
So, well, it's not the loan. These are for our programs are for conventional loans, but for these programs, because they're tied to the products that we're offering. The product
Okay.
is conventional. These programs are not eligible for every offer. So I don't hide this at all. It's anyone who can be underwritten by us and approved can be eligible for the cash backup offer, but you also have to qualify for the appraisal waiver. The appraisal waiver, I think last year was running at a 72% acceptance rate. So that's for the company. Our company is mostly East Coast, all the way, top to bottom. Not so much west of, Western U.S., but East Coast. And for all offers that were put into the program, it was 72% of those offers qualified for an appraisal waiver. So 7 out of 10 offers going out will qualify. So I'm saying, and I tell every client, not every offer you make is going to qualify. We're looking at the house. We're not sending an appraiser out to the home. We don't know that much about the property. It's just based on online information and other sales data out there. We know Zillow's estimate can be off by 10, 15% or more. So the information is not perfect.
Right.
So not every offer is going to qualify. Sometimes we're way over. And it's like, wow, I can't believe we got that number. Okay.
Right.
That house would never appraise for that much. And sometimes we're under. But the 70% of the time that we can help that client make a better offer, it's absolutely worth it.
It was interesting because, it really, you helped me be very competitive on one of my offers. I had a client who was a conventional, able to put 20% down, and we were buying in the suburban market, and I wanted you, of course, to take a look at it because we were competing with multiple offers. If it were a way that we could waive the appraisal, my client was willing to, kind of limit home inspections to everything important because they loved the house and it had been recently flipped. They went through the evaluation, and because I believe the house had been flipped, it didn't necessarily qualify for the program, which put us at an advantage, believe it or not, because we knew that we wouldn't be competing with anyone else who could come with one of your products and completely waive the appraisal.
That is a great way to. I
Yes.
like the way you looked at it.
Yes. So we knew exactly
Okay.
what we needed to do to win, and we did.
Some reason flip properties typically do not qualify, and it's simply because, and I don't know why, and it makes no sense. We've brought this up with where the information comes from, but if the home recently had a lower sales price and is now being sold for quite a bit more, some reason that recent sales price gets put into the algorithms as to the maximum numbers we can support. We all know it doesn't make sense. If someone just knocked this down or added a second level to it, that prior sale shouldn't have anything to do with the current one. I get it. It's not a perfect system. So that is one of the instances where it's probably not going to work.
Yes.
But I focus on all the times that it does help. And I tell my clients, I say, listen, the max number we can support. We didn't appraise this house. We didn't send somebody out there. We don't know that this house has a full finished basement, a beautiful backyard, granite and crown molding and all this stuff. We don't know that.
Right.
It's the number I'm giving you is simply a number representation of the level of risk my company is willing to take on your offer.
Right.
That's it. And if you know it's worth more, go for it. Go for more. This should not deter you from making a higher offer. It's just the information we have.
All right, so I wanted to, take a little bit of time and, for the last few minutes that we have here and just kind of jump into some success stories, all right? I know I kind of jumped ahead a little bit, Michael, and shared one of mine with you. But I did want to give everyone a chance to kind of give at least one example. So I'll start with you, Maurice. Can you share a story where you helped a client overcome a financial hurdle to successfully purchase their home?
Sure. So one that always stick out with me is with a Amazon worker. He worked for Amazon for 15 years. He sold his house, told him he was going to buy another house with another lender. That deal fell apart because of the structure of his pay with restricted stock units that he gets paid from Amazon. So him, his wife, daughter, and the dog are in the hotel room trying to find the next house because he didn't want to go back to renting.
Right.
So I forget how he came up. We came in contact. So I took the deal, told him, let me review it. Let's see if we can get it done. Gave him a pre-approval. He goes out shopping. We get to the restricted stock unit. And the correspondent writer says, well, I don't think we can count it. But I'm saying we can't count this because of the definition of restricted stock units directly from Amazon, how he's paid out quarterly with these stock units. I drafted out a whole 3-page letter to my underwriter stating fact for fact of how this should apply in order to add income. This guy's staying in a hotel. He has to go to work at 8 o'clock. I have to meet him at 6:30 to pick up documents in the morning just because he doesn't have access to the computer. He's working from his phone. So we're working early mornings trying to get this done. He has a great credit score. All right. So he has the money. Let's see if we can get this done. So once I pretty much drew out that letter to the underwriter, letting her know how it should be looked at, and then going online to Amazon, she talked directly with them as well through their sources. So we were able to get him closed. He's not in a hotel anymore, and I closed about 2 other deals with him from investments, refined that loan and other properties.
I mean, that's
and
wonderful.
I've been, he always refers people back to me because I took the time to do it. And meet him in the morning at 6:30 in the morning. And again, like I said before, this is about service.
I mean, it
So-
really
so,
is.
yeah.
It really is. And when you go above and beyond for your clients, they remember it. And they
Right.
refer you to everyone because of it, right?
Correct.
That's a wonderful story. All right, David, how about you? Can you share A story of where you helped a client overcome a major financial hurdle?
Well, I'll give you all our deals. They don't go in straight lines, right, guys?
Never.
No.
Never. I took a detour last week that we got around, which is great. It hasn't closed yet. It's scheduled to close later this month. So this will be the sequel podcast. I'll give a positive update. Basically, this is an NJH MFA program. One of my favorite sayings: "You don't know what you don't know." We got this product, this borrower credit approved in July, and now we're out to the market. Putting out bids, trying to find something. Really working hard to get something going. In August, the state changed the guidelines slightly. They added a criteria where all borrowers needed to have 2 trade lines to qualify to get the down payment assistance. So without the down payment assistance, this deal wasn't going to happen. We get a house under contract. We go back to underwriting. Okay, let's move to the next stage. We get a suspense notice. This loan is the co-borrower did not have 2 trade lines. The borrower did, but the co-borrower did not. And again, we need both incomes to get to where we needed to get to. We had to put our thinking hats on. You just got to find a way to get around the hurdles. Underwriter says, okay, let's check out the lease. They're currently renting. In this case, the instincts were correct. Both borrowers were on the lease. So this creates another avenue to justify a second trade line for the co-borrower. Mm-hmm. The next hurdle was, okay, we had to document 12 months of consecutive timely rent payments from the borrowers to the landlord. So, these are all
like painful experiences. I see it all on your face. Like, oh, this is what we do all the time.
knock on wood, we're able to do that. We're back in the go lane. We're moving forward, and again, we'll have an update in the next podcast. But we'll talk then.
I mean, it's going forward.
So we there's always this stuff.
It's always your creativity, right? It's always you advocating for your client with the underwriter that usually pushes a deal that would otherwise fail through.
It's the same culture, all of us. We got to get a way to make it happen.
Listen, but you guys do it exceptionally well. I can't say that every lender does, and this is why I choose you guys as my partners, because for some reason you have the extra edge, right? I don't know if it's a personal motivation, to just, do everything you can, to push a deal through. But, I love it. My clients appreciate the service. Michael, I certainly want to open it up to you to share a success story as well.
Oh, that's hard.
There's so many, huh?
Yes. I could think of a number of clients over the years that we've absolutely helped out of tough situations. It's hard to think of examples or to remember all the details.
Mm-hmm. Anything?
It comes down to a lot of it right now is that I have a fantastic team. I think I have the best team that there is in the mortgage business, and they're the ones right now digging through every file, looking at every detail, figuring everything out, and never quitting on any particular client. We do have one right now that is also in process, like David, so it's not closed yet. So I'm just thinking most recent person I know we've helped just came from another lender, was pre-approved, got a contract, going through the process for like a month with another lender, and then they find out that they can't get approved. Yeah, and just then getting referred over to us
to save the deal. Huh?
Just saying their debt to income ratio was too high, and it was nothing crazy about the income that of course happens. I've saved so many self-employed people over the years because I could read a tax return, and a lot of other places aren't good at that. So it wasn't just figuring out the income. This person just shouldn't have been approved to begin with. So they were put in this situation by being pre-approved when they shouldn't have been. But it was really Matt on my team who dug through everything and figured out a way to restructure the loan. The other lender was telling them they'd have to come up with another 100 or 100+ thousand in order to get approved. And we're able to do it with the same down payment that they were intending on putting down, just by restructuring their loan a little bit, restructuring some of the debts that they had. and making it work for them. So they're still in process with us right now. There's other issues with the property. Of course, something always comes up. It's like when there's one thing, there's always many.
Yes.
So we're waiting for them to close, but it's we're past our part. We have them approved.
Well, I mean, that's the most critical piece of it all. Okay. We are lucky to have Maurice Lewis, David Ellis, and Michael Puro here today to share valuable insights on how to secure the best mortgage for your home. Each of you, please share how listeners can reach you and learn more about your mortgage services.
Sure. All right, you can reach me at mlewis@nexummortgage.com. Phone number is 856-209-3163. And I'm always available, so reach out.
Sure. Actually, before I do, I want to give a shout out to Kim. I just think this whole concept is outstanding, creative, par for the course. Good job, Kim.
Absolutely.
Thank you. Thank you very much. Thank you.
Thank you, Kim.
Thank you for participating.
Like Maurice, I'm sure the three of us, this is a 24/7 job.
Yes.
Don't hesitate to call nights, weekends, off hours. I actually prefer off hours because I could focus better, you could focus better, just a better exchange. Best way to reach me is use my cell, 973-634-8253. Email my first initial D, last name Ellis, ELLIS, at njlenders.com.
Okay, perfect. Michael?
Sure. Everyone likes to say they're always available. I try to be too. And if I'm not, my team is. And the best way to reach me first is my cell, 973-699-6436. Email is first initial M, last name P as in Peter, UORRO, at embracehomeloans.com.
All right, perfect. Thank you all for being here. Of course, I'm Kimberly Taylor. I am a host. You can reach me at www.NewJerseyRealLife.com. And of course, my cell phone is the best way to reach me, 973-715-9751. Thank you.
Thank you.
Thank
for
you,
helping
Kim.
me kick off our first podcast. I appreciate your
it.
time.
Thank you.
Cool.
Thank you.
Good job.